You know how murder mystery fans always ask who benefits? Well, today's guest, Nick Hubble, has applied this same detective work to Monday's $4 trillion AI market shock. Now, while everyone's focused on the damage DeepSeek caused to the tech sector, Nick's latest Factel Daily piece takes a peek at who might actually come out ahead from this disruption. Now, he's challenged the knee-jerk market reaction, suggesting that cheaper, more efficient AI might actually increase demand for the very companies that got hammered. It's a bit like how fuel-efficient cars ended up increasing oil consumption, not reducing it. So, Nick, welcome, buddy.
Yeah, good to be back. That beeping I was trying to figure out earlier, it was a bird. There's a bird outside my window. So if anyone hears a load of beeping in the background, it's not. I've muted everything. It's a bird. I can't mute the bird.
Well, I can't even hear it, so I think you'd be all right. But let's start with something counterintuitive from your piece today. Now, this is the idea that AI becoming more efficient might actually benefit companies like NVIDIA rather than hurt them. Can you walk us through this, what you call Jevons Paradox concept, and how it might apply to the AI sector?
Yeah, I've just seen the search term Jevons Paradox has gone absolutely parabolic on Google. So people are cottoning on to this, and it's time everyone listening figures it out too. So Jevons Paradox is best explained with an example. It was the one you gave earlier about fuel-efficient cars, right? So if cars suddenly tomorrow became dramatically more fuel-efficient, what would that do to the world's oil demand? The obvious answer is if a car's more fuel-efficient, it'll need less oil to run. That's the incorrect answer according to something called Jevons Paradox, which claims that actually, because cars are so much more fuel-efficient, people will drive them more. It'll become cheaper to drive, trucks will become better, more trucks will be used, and so on and so forth. And so the net effect in the end will actually be an increase in oil demand because of this efficiency gain. It's the counterintuitive answer. And the question is whether this applies to what's happened with DeepSeek in the AI world, whether the fact that you can make AI dramatically more efficient in the ways that DeepSeek supposedly has means that in the end will increase the amount of time we'll be using AI, the amount of different ways, the amount of different places, the amount of different applications that use AI. And as a result, we actually need more computer chips from NVIDIA. We actually need more of these data centers. We actually need more nuclear power to power them. And the boom actually is getting bigger rather than smaller as a result of what this big DeepSeek release with the $2 trillion US market meltdown that it triggered has been causing.
Yeah, yesterday I was chatting to James Cooper, and he was kind of speculating that it could be showing signs of the tech bubble reaching a point that it can't go any further. We also sort of acknowledge that bull markets can go higher than anyone expects anyway. His view is that it's actually going to be China in the ascendancy, and it's going to lead to a commodities boom. What's your thoughts? What are your thoughts on that?
Yeah, that's an interesting one. It does remind me of the tech bubble, right? Where the internet was a very real phenomenon. If we look around us today, how much the internet has changed. I mean, we're using the internet doing this video.
Yeah.
But so the internet was very real, and the boom that it caused was very real. And some companies did actually soar in value dramatically over the subsequent 20 years. But we also still had the bubble, the tech bubble, the burst, and stock prices did crash, right?
Yeah.
So you can have both. You can have your cake and eat it. Although stock market crash is probably not having your cake. But anyway, the point being that it might all be true. There's some issues popping up around whether DeepSeek is as efficient and dramatic a change as we thought. Another analogy here is that AI companies in the US are a bit like the German car companies figuring out they're about to be undermined by EVs from China. It's a similar phenomenon. But the reason I wrote this article is because I wanted to figure out, instead of that way of thinking about things, I wanted to figure out, well, who does benefit from this, right? So rather than asking who's going to get crushed, is there a commodity cycle? Is it China versus Russia? What investors, I think, really need to focus on is who benefits.
Well, there was one beneficiary on Monday. Now, you highlighted Apple, right, for one, as the survivor of Monday's meltdown. Could you expand on why device manufacturers might be better positioned then to capture AI gains than the companies actually building the AI?
Yeah, there's a bit of a joke here about the Apple company avoided that stock market rout, and why is that the case? And one answer is that Apple's AI is so useless and so valueless that it didn't really have anything to lose when DeepSeek came out. But that's, I think, just a joke. The real story is that if you've got dramatically more efficient AI, these things suddenly become dramatically more valuable, right? Because you can do more things on them. More applications can use AI if it's more efficient and cheaper and so on and so forth, more open source. So the value of anything that interacts with AI has gone up as a result of this.
Yeah.
That includes companies like Apple, which makes these devices that we use. It also includes the companies that use artificial intelligence to do various things, such as become more efficient, to grow, or to improve their cost base, improve their revenue base, whatever it might be, to attract more customers, advertising, and so on and so forth. So that's one angle on who benefits, right? It's who can now access AI at an affordable, cost-efficient, energy-efficient level, that it actually improves their bottom line. And one example that we came up with was the same miners that James Cooper was talking about, right? The companies using AI to revolutionize, for example, exploration drilling or analysis of drilling cores or whatever it might be in the mining sector, how to design the mine around a deep deposit. AI could revolutionize all of these processes. And so some companies disproportionately benefit from that tech revolution in the mining sector on the back of AI. There's a couple of other examples of companies that can be revolutionized by these AI applications. And so that's one way of harnessing this trend, one way of thinking about who benefits.
You do actually, saying that though, you do actually make an observation about how hard it is to predict who actually captures the profits from technological advances generally. How should investors think about this challenge when trying to position themselves in the AI space specifically?
Yeah, it's something I've been really struggling with over the years, a long term now, more than 10 years. Because of the way the financial system is set up, where anyone can punt on anything at this point, it's not so obvious who benefits from a technological change or a market event or a geopolitical issue or whatever it might be. Whenever there's a shift in the market, it's quite difficult to figure out whose stocks go up, to put it simply. So, for example, with this drill baby drill thing in the US, you think oil stocks are going to boom because there's going to be more oil, like opportunities to drill oil. But if that crashes the oil price, then it's bad for oil companies. So it's not clear which of the two it's going to be. So even if, say, a year ago you were predicting that Trump would win and he'd do this drill baby drill thing, it's still not clear what your investment position should be, right? So applied to AI, it's kind of similar, where on the one hand, you've got the Jevons Paradox argument, which says companies like NVIDIA should benefit from AI becoming more efficient because actually it will increase demand for their computer chips and not decrease it, as it seems at first glance. But the market absolutely crashed. So that's a good example of how it's really difficult these days to figure out who benefits, who doesn't. Another quick example I'd really like to give, because I've just read this research report from Deutsche Bank. The German economy is in the toilet, right? It's absolutely terrible. Deindustrializing, terrible energy prices. It's all a big nightmare. But its stock market is performing incredibly well, right? It's outperforming the rest of Europe. It's outperforming most stock markets around the world. And so there's this dichotomy of, well, what's going on there? It's not as you would at first expect it. And nobody had that on the bingo card, that you'd get the German economy and the German stock market diverging so dramatically over the last few years. So yeah, it's become a real challenge, and hopefully people think that this is an opening for people like me and Greg and James, who actually have to think and research through these things to find out who really does benefit, because it's become a whole lot less intuitive than it used to be.
Let's just bring it back to the to what happened on Monday just for a second. So you've drawn parallels between current market behavior and classic bubble patterns, right? What signs are you watching to determine whether this is a genuine bubble pop or just another bump in the road on the way to absolute booming tech markets over the next few years?
Yeah, my instinctive answer was going to be don't go there. Like, you don't want to risk it. It's not worth risking. But now that the market has corrected to the extent that it has because of this DeepSeek thing, and we're kind of saying, well, this might be a buying opportunity, the question really becomes relevant again, right? And I think it's the same as with the tech bubble and the internet. right? If you're going to hold for the next 20 years and you do some careful research on who you think is actually going to win the AI race, which companies benefit most, then it's perfectly fine time to buy it. You have to pick the Amazon of AI.
Easy.
In other words, it was Amazon back in the late 90s or the early 2000s. So, but having a wide, diversified holding of, say, the Mag 7 stocks, I think is not the greatest idea. The time to invest in them has come and gone, unless you're trading something short term here with this entry point of the idea that actually Jevons Paradox suggests it's a good buying opportunity.
You've actually, talking of the Mag 7, you've actually just finished I read it yesterday. It's a really good new report that you've written. It's going to be a free resource for all Fat Tail Taily readers, and it's called the Australia's Mag 7. So my last question kind of links or touches upon that a little bit, because in your piece today, there's also an intriguing mention of how AI might revalue certain mining assets. Could you, just to round off today's discussion, just elaborate on how these technological advances might create opportunities in sort of seemingly unrelated sectors?
Yeah, there's two separate things going on here, right? There's the idea that the Mag 7 is in the US has rallied so far so high that it's no longer worth considering them. Meanwhile, especially adjusted for the currency, the Australian markets perform very badly. So at some point, the valuations should correct. So people should shift from the Mag 7 in America to the Mag 7 in Australia. I recently found out that European bank stocks have outperformed the Mag 7 over the last 2 years, which is a good example of the point I'm making, that the companies that are performing the worst over the last few years might be the best ones to invest in for the next few years. What goes up must come down. This is cyclical. All you need to really do in investing is pick the stocks that have crashed but are likely to come back in a cycle, come back again. With the tech side and the mining, there's a few things happening. AI kind of underlies them all because it gives miners the analytical power they need to process information. And at the same time, there's been some innovations that James Cooper's pointed out in his presentation. We'll probably link to it in the description, where he says there's a bunch of new technologies that will provide large amounts of data to mining companies a lot faster and a lot more cheaply than they used to be, and in a standardized way. So at the moment, you've got different geologists analyzing different drilling cores in slightly different ways because they're humans, they make mistakes and have different incentives and so on and so forth. In the future, they're going to be using the same technology to analyze, so the results will be standardizable across the different companies, and that's an important investment implication. They'll be comparable. So the combination of this new data being generated by technology and the ability to analyze it properly using AI is going to revolutionize a subset of the mining company industry or the sector. And the reason I say a subset is because there's a whole bunch of companies out there sitting on mines that have a negative net present value, meaning if they were launched as a new mine or relaunched as a mine come back to life, over the course of their life, the economic value would be less than zero, right? They would end up costing the company after having sold all the resources. But this technological revolution has the opportunity to revalue those mines much higher. So what was a marginal mine suddenly becomes a profitable one as a result of this technological combination. So that's what James has been researching and analyzing and trying to find those companies that stand to benefit most from this new technology. It's easy to presume that all mining companies benefit from new technology, but it's the ones that allow, that use that technology to make their projects profitable, to transform those into profitable projects. They're the ones whose share prices benefit the most.
Yeah. And as you say, we got a report on that very thing, and maybe we can have a pop up so that readers can see what that's all about. It's called Abandoned Gold. It's not just about gold. That's just the lead story, but that's what it is all about. Awesome, Nick. Thanks for your time. Really fascinating discussion. If you'd like to read Nick's piece, the link's below as always. It's absolutely free. Check it out and do ask some questions in the comments if you have any. Thank you very much. Cheers, Nick.